Okay, welcome to chapter 5 then of Business and Finance, which is the introduction to risk management chapter. Although we do cover a fair amount in chapter 5, actually a lot of it is going to be kind of thinking about what these different types of risks are going to be. So we'll have a bit of an introduction to what risk is. We'll think about the different attitudes and that a business can have, that an investor can have, and then we'll start going through these types of risks. Now, I'll warn you now that there are lots of different types of risk, and we've got the majority of them here. But it is important for you to make sure you make use of your study manual just to be sure of all of those different types of risks. So there are a few extras that you need to be able to cover for the exam that is not quite practical for us to fit into a set of notes. Certainly without just copying the textbook out, which is not really that much use for you guys. Okay, so let's get started. Section 1 then, introduction to risk, brings in this idea of risk and uncertainty. Now, in day-to-day life, you may find that you use these two terms almost interchangeably. So, risky, uncertain, those sorts of things. Now, both of these do kind of refer to a number of different outcomes being possible, but the key difference is uncertainty is where we have an inability to predict any sort of outcome. So with risk, we are able, due to kind of past experience, able to estimate some sort of probability. So risk is where we're unsure about what's going to happen, but we have some sort of probability attached to it. Uncertainty is where we're not even able to do that. So there's a lack of information, which makes it a lot worse for us. Like I said, there's lots of different types of risk. The first categorization we see here is the difference between upside and downside risk. Now, hopefully, that's a fairly straightforward one. Even if you got that question in the exam and you'd never even done the course, I think we'd probably be able to figure out that the risk that something going wrong would be a downside risk, and the risk that something goes right would be an upside risk. So hopefully that's fairly obvious. Now again, when thinking about how a risk will impact my business, well, again, for an overall organization, things can go well or things can go badly. So we use pure risk to talk about the possibility that something will go wrong, and we use speculative risk then to think about something that could go better than expected. So there's lots of terms that cross over that almost mean the same thing. You just need to make sure that if you get a question in the exam, you're able to differentiate between the two. Okay, so we absolutely need to recognize that when we talk about risk, it's not just the risk operationally for an organization that we need to worry about. We also need to think about risk for investors. Yes, 2.1 is very important. So risk for the business, we're going to look at lots of different types of risk there for the business. Anything that impacts our profits, anything that impacts our share price and so on, really, really important. What's important not to forget though is the risk that an investor will face. And the reason that this is really important is because we know that risk for investment is going to impact the required return that they have. Okay, so if I'm offering a very risky investment, well then I need to offer a pretty high return. We know that risk and return generally go hand in hand. High risk normally demands a high return, and low risk normally means you can get away with giving a relatively low return. So we know that we have two different types of investor as a business or as an organization. We have people who lend me money, and they have people who invest in my business in the form of shares, so debt finance and equity finance. Lenders obviously have the risk that people will not pay the debt back. So either they'll be able to they'll be unable to repay the interest payments, or they'll be unable to pay the loan lump sum at the end of the term. Now, obviously, they're going to want a higher return for a higher risk investment. Shareholders we call the ultimate bearers of risk, because they are really right down there at the end of the line in terms of who's going to get their money back if something goes wrong. We say there's a two-way risk, and that's because they have a risk in terms of their returns, so they might not get a dividend, there's no guarantee of that, and they also have this kind of capital risk, so the fact that the share price might fall. So absolutely, holders face the kind of majority of the risk there. Now, what doesn't help is because there's no fixed interest or no fixed dividend that a shareholder receives, they have a high volatility of returns. So it can be quite difficult to predict what's going to happen, and that's why lots of emphasis is put on, well, even if the business is doing poorly, perhaps we should consider paying out the normal dividend, just to make sure that shareholders are relatively happy and that the market is fairly confident in us going forward. Now, risk isn't always going to be a bad thing, and therefore we need to kind of consider different ways in which we can deal with risk. And a lot of that is going to come down to your risk appetite. So your risk appetite for an organization or for a business is just the extent to which you're willing to take on risk in order to achieve my objective. So for example, if I know there's a chance that I could double turnover in the next 12 months, but launching this product could then lead to us losing money, well, if I'm a risk seeking manager, I might think, look, there's a chance of us getting this absolutely wonderful turnover and profit for next year, so let's take it. If I'm thinking, well, I'm not willing to take on that risk of the big loss, maybe I'd be more along the lines of a risk averse attitude. So that we go through those types underneath here. So a risk averse attitude would be where we would take a more certain outcome over a potentially higher but less certain investment. So for example, if project A has a 90% chance of giving me a $100,000 profit, and project B has a 1% chance of giving me a $10 million profit, I would go with project A because it's giving me a more certain outcome, even if it's much lower kind of in dollar terms. Risk seeking, then, if we can jump down to risk seeking, they would absolutely take the slim chance of the massive profit, and they would take the higher level of risk because it means that you're going to have a really high potential return, even if it's not very likely. Risk neutral then would use an expected return method, so something like expected values, where we consider the different outcomes and the different probabilities associated with those outcomes, which you'll have seen elsewhere on your studies. Okay, now on to the different types of risks. And again, just to reiterate, make sure you've had a look at your study manual here, because there are quite a lot of these different categorizations and lots of them do cross over, so it's important that you're able to pick these out for the exam. Okay, so we're going to classify the risks or split the risk between business and non-business risk. And non-business risk we're going to think of in terms of financial risk and operational risk. Okay, so 3.2 starts to look at business risk, and we've got 5 different types of business risk here listed underneath. We're just going to go through and start thinking about the different types of risk that a business can face. So right at the top there, strategy risk, and this is the risk that we choose an incorrect strategy. So we've gone through the strategy chapter there in chapter 4, where we think about what we are currently doing, we think about what we can do going forward, and then we choose, perhaps using those Johnson and Scholes SAF criteria. And strategy risk then is the risk that you choose the incorrect strategy. So we go down the low cost route, where actually that's going to damage our brand overall, and it's going to lead to us losing money. Product risk is can be part of that, and this is just the risk that my customers do not buy my product. So really nice and simple, and that could be because they're overpriced, it could be because it's a poor product, it could be because we're a bit behind the times in terms of trends, whatever the reason, that's all going to be bundled into product risk. Financial or economic risk, put financial in there, we sometimes call it financial risk. For example, might be the effect of a big interest rate change. That's going to have a big impact on my business. And in fact, we'll see that again when we consider financial risk as a separate risk category of its own. Technology risk is where we might have outdated or inefficient technology that's going to be falling behind the times, that's going to cost us in terms of my productivity. Let's make that a bit more legible. And then property risk is going to be any risk that arises from ownership of a property. So for example, any sort of damage, fire, something like that. Okay, over the page then, we move on to those non-business risk areas. And like I said, we're going to split those between financial and operational. So we'll run through a few of these as well. So first up, we've got liquidity risk. And liquidity risk is all about, well, what happens if I run out of cash, or what is the risk of me running out of cash? It means I'm not going to be able to pay my suppliers. It means that they might stop sending me raw materials, which means I can't make my product anymore. I might not be able to pay my labor. They might not want to come to work anymore, and that means I'm going to have less products to sell, and it just kind of creates this cycle of problem. Gearing risk then is going to be to do with how much debt we have. So gearing is all about how much debt we have, for example, compared to my shareholder investments. And the problem is, for example, if we've got lots of debt, that's going to mean we've got lots of interest payments. And interest payments are a bit of a pain because you have to pay them whether you make a profit or not, unlike a dividend, for example. Default risk and credit risk are pretty similar. Default risk is the risk that I won't be able to pay back my loans. And credit risk is where I might be facing customers who are unable to pay me. Again, going to cause me big cash flow issues if that happens. Foreign exchange risk is to do with risk driven by movements in foreign exchange. So for example, I might have a change of my FX rate in the period between agreeing a transaction and settling that transaction. So I agreed to sell my product for 50,000 euros, and by the time it comes around for my customer to pay, the exchange rate has moved, and now actually that amount of euros doesn't cover my costs anymore. An example of interest rate risk could be the fact that we have a variation or perhaps volatile borrowing rates, and therefore I don't know how much I'm going to be able to borrow for in the future, so I might need to lock down a long-term borrowing now, for example. So I might need to consider that volatility. And then market risk is going to be a lot of those things rolled into one. So just any sort of change in the market that's going to cause me a problem financially. Moving on then to operational risk. Again, remember, these are just all different types of risk that the business can face. We've got an example here, or a list of 4. Now, operational risk is going to be to do with something that we do currently. So for example, the processes and people that we have working for us, or it could be because of an event. Although we don't have it specifically listed here, if there's some sort of single event that causes you a problem, or could potentially cause you a problem, we'd call that event risk. Okay, so for example, some sort of natural disaster. Okay, so the risk of my business being disrupted by an earthquake or a tsunami, something like that. Okay, let's go through these different 4 then. Process risk is just the risk that I have some sort of ineffective or inefficient processes within my organization. People risk is that I have some sort of staff problems, so staff constraints, for example. I'm unable to get hold of the right type of staff or the right amount of staff. I'm unable to pay my staff what is required to recruit and retain good staff, for example. System risk is going to be something normally to do with IT. So for example, you might have some sort of IT system capacity issue. So we're unable to carry out the amount of processes or transactions that I need to, because we've got some issue in terms of my IT system capacity. And then finally, we've got legal risk here. And for example, that might be, well, what happens if there's a new regulation in place and I haven't done enough to make sure that I'm not going to fall foul of that? So not meeting regulation, or perhaps a new regulation. Okay, so that's just a few of the different types of risk that we might need to know for the exam. Make sure you've had a look over those and you're happy to kind of pick those apart. Section 4 then moves on to risk concepts. So the risks that we've just been through aren't going to affect every business in the same way. For example, foreign exchange risk for a company that trades heavily overseas is going to be a lot more problematic potentially than for a business who does not trade overseas. So they'll still be affected perhaps, but not in the same way. And we break the scale of risk that a business faces into these 4 risk concepts. So exposure, volatility, impact, and probability. So let's have a think about these. So exposure is just considering, well, how does the nature of my business affect how much I'm affected by this risk? So for example, you'd find that an airline may have an increased risk of passengers or their customers being injured than, say, a general office worker. So an increased risk of customer injury. So they'd need to consider that way more than, for example, a firm of accountants. Volatility is talking about how much the exposure is going to change. So for example, if I'm some sort of farmer, my crop harvest is going to be massively dependent on weather, and the crop can vary massively depending on whether I have a good weather in the season or whether I have bad weather in the season. Impact is going to give me the amount. So what am I actually going to lose out on if the risk comes to fruition? And then probability says, well, based on past experience, how likely is this to happen? So although airline risk in terms of customer injury is absolutely there, past experience probably says that it's relatively low risk. Okay, the last few bits then of the chapter are going to be thinking about the risk management process. So the risk management process, which is all to do with reducing probability and limiting the impact that the risk can have, is broken down into 4 sections here underneath. So first step is awareness and identification. So I need to know what the risks are in order to be able to try and deal with them. So we can either go with a top-down approach to risk identification, which is led by senior management, or we can go with a bottom-up approach, which is where the operational guys start the process and we move upwards. Either way, really, really important that we know what the risks we're facing are. Once I know what those risks can be, I need to think about how damaging they can be. So we can use a risk mapping process to start thinking about those, for example, those 4 risk concepts. So how exposed am I by nature? What is the likelihood of it actually happening? Gross risk is a term we use for the combination of probability and impact. So how likely is the risk going to, how likely is it that it's going to occur, multiplied by how much damage it does to me as a business. Once I've done that then, and I know what the risks are, and I know how damaging they could be to me, I start thinking about controlling those risks. So I use a matrix to think about how likely they are to happen and the impact that they could have. So for example, if I've got a high impact and high probability risk, I might decide just to avoid it altogether and leave the market and not have to face that risk at all. If I've got high impact, so something that could damage me greatly but it's low probability, like a big fire in my warehouse, I can either reduce it by having good safety procedures, or I can share it, for example, by getting some sort of fire insurance. Low impact but high probability, I'll just do my best to reduce it. It's going to happen, or it's likely to happen, but it doesn't really impact me that much, so I can just try and reduce that to its minimum possible threat. And then low impact, low probability, we just accept those risks. So these are risks that are going to be pretty rare, and actually they don't really make a big difference on us at all. Now, Often people think that that's the end of the process. However, this has to be an ongoing process. It's not the kind of thing that you start your business, assess the risk at the start, and then ignore it for the rest of the time. You really need to make sure you're looking at this constantly. Very last bit then over the page, just thinking about crisis and disaster recovery. A crisis is where our risk has become a reality now. So we've got a few different types of crisis here. So a natural event, like an earthquake, for example, industrial accident, so some sort of problem with my operations, a product or service failure, so the brakes on my highest model of car having some sort of problem and me having to recall them. That's then going to lead on to the fourth type there, public relations disaster. So in terms of how we manage these things, it's important to both consider preventing the problem and also thinking about, well, what happens, what's my contingency plan for when it does happen. Finally then, for chapter 5 is disaster recovery. We've got a definition here of disaster. Breakdown of business operations leading to potential losses of equipment, data or funds. And again, you just have to have some sort of policy in place to make sure that you can come back from this. So what do I do when something goes wrong? How do I recover data, or how do I ensure that ongoing operations are not affected? And how do I make sure that I have the right people in place to kind of carry those procedures out? So overall, risk assessment, risk management, really, really important for an organization. Next up, when we come to looking at chapter 6, we'll start to think about financial information.